Today we're digging into Boston Scientific, ticker BSX, because something really interesting is happening here. On one hand, the company's report card looks absolutely fantastic, but on the other hand, the market is treating the stock like it's seen a ghost. It's a classic tale of two completely different stories, and we're going to figure out what's really going on.
And here it is, the puzzle in a nutshell. Our own diagnostics give the company's fundamentals a stellar 9 out of 10. I mean, that's an A+ by any measure. But the market's opinion, well, the technical score is just a 3. That's a massive, massive disconnect. So you have to ask, how can a business be so healthy while its stock chart looks so sick?
So yeah, that's the big question we're tackling today. Is this just a great company having a rough couple of days, or are the charts trying to warn us about something lurking under the surface? Let's dig in and find out, starting with all the reasons the company looks so strong.
All right, first up, let's build the case for strength. We're going to look at the hard numbers that show why this business, on paper, seems to be in absolutely peak condition.
First thing you notice is the profitability, a gross profit margin of almost 68%. Now think about that for a second. For every single dollar of product they sell, they get to keep almost 68 cents before other expenses. That is a huge sign of efficiency and, real pricing power.
And the numbers just keep getting better. This right here is their cash-up score, over 90%. What this basically measures is how good they are at turning those paper profits into actual, real cash in the bank. It tells us they aren't just book smart, they're street smart. They know how to generate cold, hard cash.
So let's just put this all together. You've got strong profitability, you've got high cash generation, you've got excellent liquidity. I mean, every single one of these metrics just screams financial health. On paper, this company is an absolute champion, which makes you wonder, why is the market treating it like it's about to get knocked out?
And this, right here, is where the whole story just takes a sharp turn. Forget the company's beautiful report card for a minute. Now we're going to look at the stock chart itself, where some pretty serious red flags are starting to pop up.
And really, it's as simple as that. It doesn't matter how great the underlying business looks. Right now, the charts are telling a completely different story. And frankly, it's a bit of a scary one.
Okay, let's get specific. In just the last 5 days, we've seen 3 negative indicators pop up and 0, not a single one, positive signal to offset them. We've got an overbought reading, which is kind of like a rubber band that's been stretched way too far. We've got a hanging man pattern on the chart, a classic warning that a top might be in. And there's also a MACD divergence. You don't need to be a Wall Street pro to get the message here. All of these signs are telling us that the stock's upward momentum is seriously running out of gas.
Now, chart patterns are one piece of the puzzle, but to really understand what's happening, you have to follow the money. Where is it actually going? Is it flowing in or is it flowing out?
And wow, this is really telling. It doesn't matter if you're looking at the big institutions or the small retail investors like you and me, the story is exactly the same. The inflow ratio is below 50% for everybody, which means one simple thing: more money is leaving the stock than coming in. People aren't stepping up to buy the dip. It looks a lot more like they're quietly heading for the exits.
Even the experts seem to be split on this. The average analyst rating you see everywhere is a solid buy. But here's where it gets really interesting. When we only listen to the analysts with the best track records, the ones who've been right the most often, that rating just plummets to a hold or maybe even a sell. It suggests the pros who really know their stuff are getting pretty cautious.
So, what do? We've got two completely opposite stories. We've got a fantastic company and a really nervous market. How in the world do we make sense of all this chaos and come to a logical conclusion?
Well, the key is to realize that we're actually asking two very different questions. The fundamentals, they ask, is this a good business? And for Boston Scientific, the answer is a clear yes. But the technicals, they ask a different question. Is this a good time to buy? And right now, the charts are kind of screaming, maybe not. The most important thing to get here is that both of these things can be true at the exact same time.
So, let's wrap this up. Here's the big takeaway. We can confirm, yes, Boston Scientific is a fundamentally solid company. But its short-term market momentum is undeniably weak. With money flowing out and all those technical red flags waving, the message from the data is pretty clear. Be careful, especially if you're looking for a quick profit. This quote from the analysis really just sums it all up perfectly. It's not a warning against the company itself, but it is a clear call for patience. The market seems to be telling us that if you can just wait a little bit, a much better opportunity to get in might be right around the corner.
And so this whole thing really boils down to one final crucial question that you have to ask yourself. Are you a long-term investor looking to buy a piece of a great business for years to come? Or are you a short-term trader, just, well, renting the stock for a quick ride? Because for Boston Scientific, right now, the answer to that question changes absolutely everything.